Hello and welcome to today's presentation of the capital markets review for first quarter of 2022. My name is David Williams, and I am a senior consultant as well as director of investment services at Multnomah Group. We're going to start off with a quick review of economic activity here in the U.S. and then get into a review of performance of the capital markets for first quarter. Without understating the obvious, the Russian-Ukrainian war has added to both uncertainty as well as inflationary pressures, both of which markets generally do not like, and we've seen results that are to the negative side of expectations going into 2022. The last print of U.S. GDP was for fourth quarter of 21. It came in at about 6.9% on an annualized rate. First estimates or early estimates of first quarter 22 GDP are to be released later this week. Consensus expectations are that you will see a significant slowdown in economic activity, but still positive growth. Consensus expectations for about 1.5% annualized growth for first quarter of 2022. Over the full year of 22, expectations are for right around 3% of GDP growth. Obviously, again, the Russian-Ukrainian war has increased inflationary pressures, accelerating those inflationary pressures, and really we're seeing a diminishing hopes that the inflationary pressures first reported in 2021 as being transitory. Maybe those aren't quite as transitory as were hoped back in 2021 coming out of the COVID pandemic. The Fed certainly has a dual mandate of maintaining stable prices and full employment. On the unemployment side, certainly seeing improvement there. A year ago, March 31, 21, in unemployment was right around 6%. That's declined to about 3.6%. We certainly are seeing some wage growth higher than recent trend at about 5.6%. It's on the inflation side that the Fed is, having its most pressure applied to it, with core CPI up 6.5%. So core CPI excludes food and energy, two very volatile segments of the calculation. That 6.5% is the highest that we've seen since the early 80s. If you factor in food and energy, the year-over-year increase is about 8.5%. That's the headline CPI number that often is reported in the financial press. The Fed took action in March, raising interest rates 25 basis points at their meeting in March. The consensus expectations have ratcheted up for Fed action through the first quarter of 2022. At the beginning of 22, there was an expectation of 3 rate hikes during the year. That has increased with the invasion of the Ukraine, all the way up to currently about 9.3 expected rate hikes during the year. As we translate this to, setting the stage for the capital market performance, starting with the U.S. equity markets, the S&P 500 declined 4.6% for the quarter. I think it's really important to take a look at the chart in the upper left-hand corner showing performance by sector. What you'll see is that all sectors of the S&P 500 declined for the quarter, with the exception of energy and utilities. The energy sector was up, not surprisingly, very, very strongly, given the inflationary pressures on both oil and natural gas. That sector was up 39%. The utility sector up positively, but much more modest modest appreciation. I think it's important to note that this difference in sector performance will play through to many of your manager returns for the quarter, as some styles will have more exposure to energy than others. So the value side of the equation, the Russell 1000 Value Index, has about 7% of its total weight in the energy sector, compared to the Russell 1000 Growth only having 0.5% in the energy sector. So I think what you'll see as you review performance with your consultant later this quarter is that energy weight was a weight both on a positive or an underweight would be a real driver of performance for the quarter. We see there midway through the page that the value side of the equation outperformed growth pretty strongly for the quarter, and large cap stocks tended to do a little bit better than small cap stocks for the quarter. There's a bit of a divergence on the 1 year side, with large cap growth outperforming large cap value, but small cap value outperforming small cap growth. You see longer term, again, looking at the 5-year performance, that growth still outperforming value, but that deviation, or that delta, has narrowed fairly significantly. Looking at valuation, forward price to earnings ratios for stocks are currently running about 19.5 for the S&P 500 versus a long-term average of 16.8. We are starting to see that forward price to earnings ratio come down as stock performance has come down, lowering the price component of that equation. Profit margins still remain very high relative to history, at running right around 13% for the broad market. Flipping to the fixed income market, the Bloomberg Aggregate Bond Index was down 5.9% for the first quarter. That's the worst quarterly performance since the early 80s. The yield curve steepened significantly as a result of the Russian-Ukrainian war, accelerating inflationary pressures and really turning the Fed more hawkish, but also setting expectations for future rate hikes. And so we saw that yield curve rise pretty strongly on the short end of the curve, and is very flat to somewhat inverted at the intermediate to long end of the curve when you compare the intermediate to the long end of the curve. The 5-year Treasury had the largest quarterly increase in its yield since 1987. So the largest increase in the yield on 5-year Treasuries occurred in the first quarter. The 10-year Treasury, typically viewed as a bellwether for the Treasury market, went from 1.52% to 2.3% during the first quarter. As you can see in the chart in the upper left-hand corner, all segments of the bond market were negative, had negative performance, with the exception of the shortest term maturities, those 3-month T-bills, eking out a very small positive gain. We did see spreads widen, so the spreads between Treasury and light duration investment grade and high yield credits widened during the quarter, accounting for some of that additional decline in performance relative to light duration Treasuries. Non-US bonds underperformed US bonds for the quarter. So if your managers were using international bonds as diversifying agents, that would have been a detractor again for the quarter. Moving forward to the international equity markets, the MSCI All Country World ex-US Index, which is a proxy for liquid equities outside of the US, was down 5.3%. This index includes both developed and emerging market equities. Developed markets did marginally better than emerging market equities for the quarter, with Asia doing a little bit better than European equity markets. Obviously, European markets more acutely impacted by the geopolitical situation and unrest resulting from the Russian invasion of the Ukraine. China equities were weak during the quarter, continuation of the zero COVID policy causing disruption and concerns about future growth. We did see the dollar appreciate during the quarter. That also detracted from returns for US-based investors in non-US securities. Couple of final comments on the non-US or the international equity markets. Generally more diversified from a sector, I guess, standpoint. There's less concentration in technology, more financials, commodities outside of the US. So more, I guess, diversification across sectors for opportunities for non-US investors than here in the US. Also, we do see current price to earnings ratios trading in line with longer term averages. So current PE is around 13.2 versus a 20-year average of 13.3 for the index. Last couple of comments on this quilt chart. Natural gas and oil were up significantly from a price standpoint during the quarter. Natural gas up 32% and oil up 33%. You can see on the far right that commodities were up 25%, and virtually all other typically offered asset classes in defined contribution plans were negative, with the exception of cash. Appreciate your time, and thanks for listening to our presentation of the capital markets. If you have any questions, feel free to reach out to your Multnomah Group consultant or myself. Have a great rest of your day.